There is a state in America with an income tax that charges retirees precisely $0 on their Social Security, 0 on their pension, 0 on their 401k, and 0 on their IRA. No ceiling, no phase out, no income restriction. And most retired people have never even thought about it because they notice the words income tax and they stop looking. Meanwhile, retirees in 3 other states are surrendering $3,000, $4,000, $5,000 annually in state income tax on retirement income that dozens of other states do not tax at all. And many of them have no clue because nobody sat them down and presented the actual figures. Today, I am ranking the 5 best states for retirement income taxes and the 3 worst. Not based on headlines, not based on what your neighbor mentioned, based on what each state actually does to your pension, your Social Security, your 401k, and your IRA in 2026. This video is for educational purposes only and is not tax or financial guidance. Consult a qualified tax professional before making any decisions about your specific circumstances. Every week, this content breaks down the tax rules, the financial pitfalls, and the strategies that shield retirees from the things nobody else is clarifying. If that sounds like something you require, tap the subscribe button right now and activate notifications so you never miss an update. Let me begin with the 3 states that are draining retirees of the most money right now, and the first one is going to catch a lot of people off guard. Number 3 on the worst list, Vermont. Stunning state, breathtaking scenery, some of the finest autumn foliage in America, and one of the worst places to retire on a pension. Vermont begins taxing your Social Security benefits if your income exceeds $50,000 as a single filer. That is the lowest threshold in the entire nation. Your pension gets taxed at rates up to 8.75%. Your 401k withdrawals, identical treatment. Your IRA distributions, identical treatment. And Vermont has a flat 16% estate tax waiting for you beyond that. Let me attach a dollar figure to it. A retiree drawing $50,000 from a pension and collecting $25,000 in Social Security is facing $3,000 to $4,000 annually in state income tax on retirement income in a state that also has some of the steepest property taxes in the Northeast. That is genuine money departing every single year. And most individuals who retire in Vermont do it for the lifestyle without ever calculating the tax figures. Number 2 on the worst list, Minnesota. I understand what you are thinking. Minnesota has the Mayo Clinic. Minnesota has excellent hospitals. That is accurate. But none of that matters to your finances when the state is taxing your retirement income at 9.85%. Minnesota taxes your pension, your 401k, and your IRA withdrawals at that rate. It also still taxes Social Security for anyone earning above roughly $84,000. And they maintain an estate tax that activates at $3 million. A retiree with a $65,000 pension and $25,000 in Social Security is paying roughly $4,500 annually in state income tax. That works out to $375 monthly straight out of your retirement check every single month for the rest of your life. And then there is the biggest one. Number 1 worst state for retirement taxes, California. The state with the highest income tax rate in America, 13.3% at the top bracket. California does exempt your Social Security, that is factual, but it taxes every other dollar of retirement income you possess. Your pension, your 401k, your IRA, your annuity income, all of it. No exclusion, no deduction, no special consideration for retirees. A retiree with $60,000 in pension income and $30,000 from an IRA is handing California somewhere around $5,400 annually in state income tax. And that is before you contend with a median home price near $900,000 and wildfire insurance premiums that have doubled in the past 5 years. $5,400 annually. For 20 years of retirement, that is $108,000 in state income tax alone on money you already saved and already paid federal taxes on. That is a residence. That is your grandchildren's education fund. That is vanished. Now, you are probably thinking the obvious strategy is to select a state with no income tax. Florida, Tennessee, Nevada, Texas, load up and relocate. That makes perfect sense on the surface. But here is what actually occurs when retirees make that transition based on the income tax headline alone. Some of them end up spending more, not less. States that do not charge income tax still require revenue, and they obtain it somewhere. Property taxes, sales taxes, insurance expenses driven by hurricane and wildfire risk, association fees that increase every year. So when I ranked the states, I did not merely examine income tax. I examined 5 categories: retirement income tax treatment, property taxes and housing expenses, healthcare access, cost of living, and hidden expenses like insurance and estate taxes. Let me present you the 5 states that came out on top, counting down from 5. Number 5, Iowa, the Midwest sleeper. Iowa recently restructured its entire tax code, and starting at age 55, all of your retirement income is exempt from state tax. Social Security, pensions, 401k, IRA, zero. And they abolished their inheritance tax in 2025. Eliminated. The flat income tax rate is declining to 3.9%, but retirees will not even encounter that rate on their retirement income. Iowa has limitations: frigid winters, restricted metro amenities outside Des Moines, property taxes around 1% that are not inexpensive, and healthcare access outside the major metros is sparse. But on pure retirement income protection, Iowa is accomplishing something most people have not observed yet. If you can tolerate the winters, the tax arithmetic is difficult to surpass. Number 4, Nevada. No state income tax, no estate tax, no inheritance tax, and property taxes that rank 3rd lowest in the nation at 0.47%. A retiree with a $400,000 residence in the Las Vegas area is paying roughly $1,880 annually in property tax. That is everything. But the compromise is healthcare. Nevada ranks 35th nationally with about 188 physicians per 100,000 residents. Compare that to a state like Pennsylvania at 280 per 100,000. If you are healthy and do not require regular specialists, Nevada functions beautifully. If you are planning for the next 15 or 20 years and want a deep roster of doctors you can actually schedule appointments with, that gap is significant. Number 3, and this is the one I have been leading toward, the state most people would never include in a top 5 retirement video, Pennsylvania. I understand. A state with an income tax. Most people hear Pennsylvania and retirement in the same sentence, and they continue scrolling. Here is what they are overlooking. Pennsylvania exempts 100% of your Social Security from state tax, 100% of your pension, public or private, 100% of your 401k withdrawals, 100% of your IRA distributions. No income ceiling, no phase out. The flat 3.07% rate only applies to earned income, investment income, and capital gains. So if you are a retiree living entirely on Social Security, a pension, 401k withdrawals, and IRA distributions, your Pennsylvania state income tax bill is $0. Functionally identical to Florida, functionally identical to Tennessee, functionally identical to Nevada, but nobody discusses it because the state has an income tax and people stop reading right there. Let me attach a dollar figure to it. That same retiree in California paying $5,400 in state income tax, that exact same individual in Pennsylvania pays 0 on the pension and Social Security. They would only pay 3.07% on their investment income. If they have $30,000 in investment income, that is $921. Total state income tax bill, $921 versus $5,400. That is a savings of $4,479 every single year. Now here is why Pennsylvania did not land at number 1. Property taxes. In many parts of the state, you are looking at $6,000 to $9,000 annually on the kind of residence most retirees are actually purchasing. And Pennsylvania has a 4.5% inheritance tax on assets you leave to your children, 12% to siblings. That is roughly $45,000 on $1 million estate passed to your kids. Those are genuine expenses, and I will not minimize them. That is what keeps Pennsylvania at number 3 instead of number 1. But for a retiree from the Northeast who wants 0 tax on retirement income and world-class healthcare within driving distance, Pennsylvania might quietly be number 1 on your personal list. It depends on your circumstances. And that is the point. The best state is the one that matches your specific figures, not the one with the best headline. Let me provide you a real illustration of how this plays out. Take a married couple, both 68. He has a pension of $72,000. She collects Social Security at $24,000. They have about $15,000 in investment income from dividends and interest. Total household income, $111,000. In California, they are paying state income tax on the pension and the investment income, roughly $7,200 annually. In Minnesota, roughly $6,800. In Vermont, around $5,000. In Pennsylvania, they pay 3.07% on the $15,000 in investment income only. That is $460. The pension is exempt, the Social Security is exempt. Their state income tax bill dropped from $7,200 to $460. That is $6,740 back in their account every year. Over 15 years of retirement, that is over $100,000 on the exact same income, just a different state. Now compare that to Florida. Zero state income tax. Sounds superior, correct? But their homeowners insurance in Sarasota is $7,800 annually. In the Philadelphia suburbs, it is $1,400. That is a $6,400 difference in insurance alone. Add in flood insurance in Florida, and the gap grows even wider. The pension tax savings in Florida versus Pennsylvania is zero because Pennsylvania already exempts it. So they are paying $6,400 more in insurance to save zero in pension tax. The arithmetic does not work. That does not mean Florida is incorrect for everyone. If you desire warm weather 12 months annually and your residence is in a low-risk inland area with reasonable insurance, Florida is still outstanding. But if you are making the transition purely for the tax savings, you need to see the complete picture before you load the moving truck. Number 2, Tennessee. No income tax, no estate tax, no inheritance tax. Property taxes averaging just 0.56%. Nashville has strong hospitals. Vanderbilt is right there. Cost of living runs about 7% below the national average. Tennessee earns this position honestly. And yet it has one weakness most people completely overlook. Tennessee has the highest combined sales tax rate in America, roughly 9.6%, and it taxes groceries at 4%. A retiree spending $50,000 annually on taxable goods is paying close to $4,800 in sales tax. That is $400 monthly that never appears in any tax-free state article. For comparison, Pennsylvania exempts all groceries and all clothing from sales tax. That gap accumulates fast over a 20-year retirement. Tennessee is still outstanding, but the sales tax erodes the savings more than most people realize. Number 1, Florida. Florida earned this position. No state income tax. It is written into the state constitution. No estate tax, no inheritance tax, massive retiree infrastructure, senior communities, geriatric specialists, airports everywhere. The homestead exemption protects your property tax assessment with a 3% annual ceiling. On the full scorecard, Florida prevails. But I would not be fulfilling my responsibility if I did not provide you the complete picture. Homeowners insurance in Florida now averages over $7,000 annually, highest in the nation. In coastal counties, you are looking at $10,000 or more, plus flood insurance on top of that. Hurricane risk is genuine and it is priced into every policy. A retiree who saves $3,000 annually by avoiding state income tax and then spends $5,600 more on insurance than they would in the Northeast just lost money on the relocation. Florida still functions. It functions really well for a lot of people, but you have to calculate the full figures, not just the income tax line. Now here is what shifted in 2026 that makes this ranking different from anything you have encountered before. Recent federal legislation created the new $6,000 senior bonus deduction at the federal level. If you are 65 or older with modified adjusted gross income under $75,000 single or $150,000 joint, you receive an additional $6,000 deduction on top of everything else. $12,000 for married couples where both spouses qualify. This is brand new. It did not exist before 2025. And it alters the arithmetic on which state saves you the most because it reduces your federal taxable income regardless of where you reside. The state and local tax deduction ceiling also jumped from $10,000 to $40,400. For retirees in high property tax states who itemize, that is a massive shift. If you switched to the standard deduction back in 2017 and never reconsidered, you need to calculate the figures again. The arithmetic may have reversed, and with the recent market downturn hitting retirement accounts, Roth conversions in a declining market are more attractive than ever. If you are between 62 and 73, converting traditional IRA money to a Roth while prices are depressed means you pay tax on a lower amount and all future growth is tax-free. The state you reside in affects how much that conversion costs. In California, a $50,000 Roth conversion costs you an extra $6,650 in state tax. In Pennsylvania, it costs you $0 because IRA distributions are exempt. Here is what this all comes down to. There is no single best state for every retiree. Florida prevails if warm weather and zero income tax are your priorities and you can absorb the insurance expenses. Tennessee prevails if low property taxes and low cost of living matter most and you can accept the sales tax. Nevada prevails on simplicity and low housing expenses if healthcare access is not a concern. Iowa is the sleeper if you can manage the winters. And Pennsylvania is the one most people overlook because they never got past the words income tax. The wisest approach is calculating the arithmetic on your specific circumstances, your pension amount, your Social Security, your 401k balance, your IRA withdrawals, your residence value, your insurance expenses, your health care requirements, all of it, not chasing a headline, calculating the figures. Now you understand which states protect your retirement income and which ones take a massive portion. But here is what most people do not consider next. Once you select the right state, you still need to make certain you are claiming every deduction you are entitled to. The $6,000 senior bonus deduction just mentioned is brand new, and most tax software is not flagging it automatically. If you missed it on your 2025 return, you can still amend. Watch the video on the 7 tax authority changes in 2026 that are costing retirees thousands, because it breaks down every deduction and deadline you need to understand. If this video helped you, tap the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, tap subscribe and activate the bell so you do not miss the next one. And if you know someone who is contemplating where to retire, forward them this video. The difference between selecting the right state and the wrong one could be $100,000 over 20 years of retirement. Leave a comment. What state are you retired in? How much are you paying in state taxes? Every single one gets reviewed and the most common situations become future videos. See you in the next one.